Hey everyone, welcome to Retire with Style. I'm Wade. I'm here with my trusty co-host Alex, and we're continuing actually with the final episode in the arc on alternative investments. In particular, Alex will talk about last week. The coverage was real estate, both commercial and residential, and REITs, as well as infrastructure. This week we have on the agenda is going to be natural resources, commodities, and a special bonus on catastrophe bonds. And then also we realized that actually last week, Alex blended some of the material on natural resources into the infrastructure discussion. So we'll do a quick review of that and make sure everyone's clear on which is which. But we'll get things going here. Alex, welcome back. You're going to be our main speaker today and finishing up this arc on alternative investments. It's
Yeah,
been
thanks for
quite an
in my
exciting series.
excitement. In my excitement, I couldn't help it, and I bled into excuse me. I blended into the natural resources and infrastructure, if you will. So just to clear it up, again, the infrastructure is specifically related to, like, think about it, toll operators, utilities, investments in private infrastructure companies. Now, again, there's daily liquid ETFs that you can buy into that, and there's listed infrastructure companies such as toll operators that you can invest directly into, and there's even interval funds by like Brookfield and Stone Peak that offer private exposure to those. But again, this is not an endorsement. This is like a starting point for you folks to do due diligence if infrastructure is something that appeals to you.
I
Then
think you
there's
need a
even private.
T-shirt that
Say it again.
says. I think you need a T-shirt or a hat that says this
Right?
is not an endorsement,
Yeah, exactly.
nor a non-endorsement.
Yeah. Like, individually, yeah, each of these can make sense. There's also, these have longer lockups, such as, there's private infrastructure funds that those lockups tend to be 10 to 12 years, if you will. But there's more of an institutional focus with those, right? And so that was the infrastructure piece that I started blending with natural resources. Now, with natural resources, those are specific, those are long-term real assets, income and inflation protection, and those include timberland, farmland, water rights, mineral royalties, things along those lines. And they offer both biological and land-based growth opportunities uncorrelated to the markets, because if you can imagine, farmland has nothing to do with the market itself. The S&P goes up doesn't mean that crops aren't going to grow this year, right? And water rights, everyone's going to drink, etc., etc., etc. And again, capital appreciation from those is through land value and resource demand. Now, there's many, you can own it directly. There's interval funds that allow you to do that. There's timber ETFs such as Wood and Cut that track forestry companies. And there's private limited partnerships for agriculture, water rights. And so there's the availability to be able to invest in these. Again, the caveat is if it's private, you're most likely subject to the accredited investor limits. That being the case, we can move on now to commodities. Now, this is a question that comes up all the time. In fact, I was playing. Guess what I was playing this morning, Wade?
Pickleball.
Yeah. Invariably, someone asks, "What do you do for a living?" We tell them what we do. I do for a living.
Professional
And
pickleball
right
player.
now, you're getting a lot of, "Hey, what about gold?" Things along those lines. And the idea is that it serves as an inflation hedge against geopolitical shocks. That's why I want gold. Whenever people start thinking about the dollar, gold starts coming up, right? And so ultimately, commodities offer exposure to real assets, tangible assets, and you're going to be subject to just the general global supply and demand dynamics around that. A lot of folks will say they're uncorrelated or negatively correlated to stocks or bonds, and they enhance diversification and improve risk-adjusted returns. Now, that's what they say. Do they do that? I'm of the opinion, I'm not a gold bug by any means. I'm of the opinion that over the long term, commodities, especially hard metals and the like, they effectively track inflation. And they track inflation with a standard deviation that's more so than stocks. And so, theoretically speaking, something that moves, if you're watching this on YouTube, it'll make sense. If you're listening, it won't make as much sense. So I encourage you to go to YouTube, Retire with Style. But if gold has this kind of volatility, and I'm effectively
Making
doing
big.
doing like an up and down movement with my arm, the entire size of my screen. If gold moves like this, and stocks move like this, and I'm not moving, I'm just covering half the screen with my finger like this, it is it is statistically very difficult to say that the first item that I mentioned, gold, is hedging stocks, simply because gold, the long-term return of gold is, roughly a little bit like inflation. Stocks have a significantly higher return than inflation. They have a standard deviation of, let's say, about 17. And gold, hard metals have standard deviations that are, that plus more. So to get a lower return for significantly more standard deviation, to say that that is, hedging against the other, it's very hard to say. You're going to need like 400 years of data to able to disentangle the signal from the noise of that relationship. So I don't think it's as easy to just say, yes, look, and yes, okay, over the last 3 months, it's done such and such. But again, it's going to trend up, it's going to trend down, it's going to trend up, it's going to trend down. And
You know
that's
what the
why
correlations look like? Because if it had a very negative correlation, there could still potentially be value. But
they're not, and frankly, if you hold that asset class, it's just going to drive you bonkers, simply because, yes, you can have 3 months of great returns, but you're going to have 3 months of crapper returns. And then in the end, what did you get? You got something that basically tracks inflation for the headache. To me, I that's not something that is interesting from my vantage point. And the standard deviation is so high on these. That's why commodity trading advisors use them a lot, because they have so much momentum built in. I don't want to play the momentum game when it comes to anything from an investment standpoint, especially with regards to my retirement income ability, my ability to draw retirement income from a portfolio. So from that vantage point, I don't see it. I'd rather invest in companies that use the commodities to make earnings, as opposed to the commodities themselves. To me, the commodities are an input. They're not an output, and so they're not that interesting to me. But that being the case, people have different ideas than I do around this, and that's fine. That's what makes the world go round. But here, commodities, they include both hard commodities, which are like metals and energy, the oil, and soft commodities, which is considered like agriculture and livestock. All right. Now, can you access them? Yeah, absolutely. And you have precious metal ETFs that have them. You have agricultural ETFs, specific to wheat, to corn, and the like. And these are long only. You have energy ETFs such as USO or XLE that offer direct exposure to specific energies. Now, if you're going to expose yourself in commodities, to me, the momentum is so strong in these that to just go long only over an extended period of time, I think the return is effectively inflation. And so, from that vantage point, you're better off if this is something that's interesting to you, to consider more CTAs, commodity trading advisories, where you're going to play the momentum game and they're going to go long, short, depending on where the momentum is going. Right? There's also futures-based strategies with regards to commodities. You see that with Goldman Sachs. They have opportunities to invest like that. And you see commodity like notes, you see structured products, and the like. You don't need to own like gold bullion or things along those lines. You can get funds that just do all that stuff for you.
now there's a lot of companies that are spending a lot on marketing, selling gold to the public.
You tell me, Wade. What do you think of those? You wake up Saturday morning. I know. You just as an aside, I'm sure people are wondering, what do you think about that? Obviously, I think people can gather what my thoughts on that are after I just spent 5 minutes talking about gold. What do you think when you wake up Saturday morning? You're going through the stations, and you see people talking about gold coins or just gold in general.
Yeah, I'm just wondering if it was such a great investment, why they're spending all this money trying to sell it to you rather than just keeping it for themselves. I guess they get some sort of service fee, but it makes me suspicious whenever Someone's spending a lot to market something that they're claiming is a great investment.
I ultimately think I think those people know what they're doing in a bad way. I think ultimately they're just taking advantage of fear. They're taking advantage. They'll make the argument that, oh my goodness, the dollar is going to hell in a handbasket, and you need to get out now. And gold is the only thing that offers, a good diversification play from this. Blah 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 blah. I don't subscribe to that at all. I think those arguments are weak when you start looking at the numbers over the long term, as opposed to finding some sort of 10-year period where something did well versus something else, and picking and choosing like that, or cherry picking, a better word, like that. I think ultimately at the end of the day, commodities are best used by companies to make something, to earn, to use that. And by make something, I mean to make profits from it. I think commodities in and of themselves are inputs that track inflation. I don't know how else to say that. I can say that in 20 different ways, but that's ultimately my conclusion. If you feel you can trade on it, like, oh, I think for the next 6 months, gold is going to go up because people are just doubting the dollar, and the U.S. isn't going to be the currency of choice anymore, and et cetera, et cetera. If you feel you can do that, then no one's stopping you. Do I think that's what you should be thinking about when creating a retirement income portfolio, to try to take consistent distributions from your portfolio? I think there's better ways to allocate your resources than commodities, if you will. Wait,
Fair enough.
yeah. And so, with regards to that, what kind of rates are you looking at? Well, again, infrastructure and natural resources. With regards to commodities, you're looking at, again, inflation at best, and then in the high single digits. The correlation to equities are low. They're not extremely high, but again, I think you just have to look at long-term correlations relative to the standard deviation that they're bringing into play, and seeing how that works out. I mean, maybe there are many things that could be uncorrelated with the market. I've said it many times, like baseball cards are uncorrelated with the market. Honus Wagner, that kind of thing. Does that make it a great investment within a portfolio? I don't know, right? I would say probably not. So you want to kind of look at not just the correlation, but what's the individual return per unit of risk that that's bringing to the table, and how does that play in? I have trouble seeing how something that returns below equities, and it's more similar to inflation with a standard deviation that's equity plus, makes sense within a portfolio. And again, yes, there will be 6 month period where it looks like, wow, this thing is like 30% in 6 months. Why don't I have this in my portfolio? Well, give it time, right? See how it looks like in 15 years, which is the time horizon you should be having, right? But at the end of the day, pure infrastructure, we alluded to it in the last episode. Again, the return drivers from infrastructure plays come from usage fees, government payments, inflation pass-throughs. That's interesting to me. Risk adjusted returns are favorable, simply because you're getting this consistent stream with, a steady sort of tangible holding. Farmland, and timberland, they produce consistent real returns over decades, largely because, different than, like, let's say, gold, there's biological growth that comes with that. There are cycles, there are commodity cycles to it, but you cut down a tree, it grows again. Not there's new growth from a seed, et cetera, et cetera. So you can get repeat usage from it. And you can lease it out. There's even a component of rental units, in the sense of you have a parcel of land, you're leasing it out, you're getting that low operational correlation around the board. So it's interesting. And if you look at historically, natural resources like this have less of a drawdown than commodities, if you will. So to me, it's interesting, especially when you throw in water and royalties that can come off of that, like water resources and the like, water rights, better said. Commodities to me are just too volatile. Sure, they could be beneficial because they track inflation and the like, but it's just, or during crisis regimes, and that's a way of saying when people are scared. But to me, I think there's nothing there. Again, I'm not saying it's not valuable in of itself, but again, I'd rather invest in gold, in silver, in metals from the standpoint of how I'd rather invest in the companies that use them, because whatever prices of commodities are, that would be reflected in the profits of those underlying companies. And so that's how I would rather do it, by proxy, in that manner, as opposed to direct investments. All right.
Okay.
And so ultimately, though, what you'll find is these are available in liquid and semi liquid structures, and they're also available in liquid structures, some of them. Obviously, commodities, you can get them liquid, but the reality is to be long only commodities is a tricky play. You usually see CTAs as a better play with commodities because they can go long and short. Natural resources, it's hard, unless you're Ted Turner and own half of Montana, kind of thing. And so effectively, there are REITs that focus on timber. There's REITs that focus on farmlands. There's interval funds that provide a little more direct exposure, as opposed, those REITs are investing in forestry companies. Interval REITs will give you direct exposure to those, and there's some crowdfunding platforms that offer you exposure, such as Farmland Partners, Acre Trader, and things along those lines. Right? Infrastructure plays, again, it just depends on what it is, such as water rights and the like. But ultimately, there's some core open-end funds that you can do it, but you're going to see private LPs that offer you the best direct investments in those, if this is something that you wanted to have a part of. Now, that being the case, the last item that I want to talk about are insurance linked securities. In our space, these are catastrophe bonds, and under that, there's many ways to participate, either through bonds or through what's called quota shares. Now, insurance linked securities is something that within the advisory space, you're seeing a lot more attention being paid to by advisors. And I think it's merited, frankly. And from here, what is this? What are catastrophe plays? And so, at the end of the day, for anything, you have to ask yourself, why should I why should I have an expected return for this? Right? What is the expected return for this? And to me, an asset class is something that, if you systemically expose your portfolio to, you should have an expected. You should have a long-term expected return, and that the genesis of that usually because there's some sort of risk that you're bearing. There's some risk that you're bearing. Hence, there's an expected return for bearing that risk. An asset class isn't necessarily like baseball cards. That's an asset class. There's no expected return from that. There's just the hope that there's going to be somebody that's going to want to pay more for my Ken Griffey rookie card than what I purchased it for. Right? That's ultimately what you're betting on there. There's not necessarily some sort of risk that I'm bearing, for holding Ken Griffey's rookie card. Now, catastrophe bonds. Again, if you think about what's happening, is there's a transfer of natural disaster risk from the insurer to the investor. At the end of the day, catastrophe bonds are hurricane insurance, earthquake insurance, the California fires, fire insurance, things like that. And so think about the risk there, right? In a similar way that Wade talks about annuities have this ability to pool mortality risk, right, among many investors. Well, if insurance companies all of a sudden can pool natural disaster risk across many folks, they diversify a little bit, right? And they're passing on those risks to you. But if you think about natural disaster risk, how is that correlated with the market? How is an earthquake in I don't know? I'm thinking of in Japan related to the stock market, right? It just because the market went down doesn't mean, oh, it's correlated with an earthquake, so we should expect an earthquake any moment now. No, it just happens randomly, if you will. And so, from that standpoint, think about the uncorrelated return stream that's tied to catastrophe events, right? There's a bearing of risk for compensation. I'm holding a bond that's predicated on natural disaster risk, right? There's that, and all of a sudden, should I have a you're providing insurance effectively, so you can see the risk transfer argument there, and you could also see the correlation argument where it has nothing to do. with the stock market, right? And so you have a low correlation to equities, low correlation to bonds, and in addition, low correlation to macroeconomic factors. Whether a hurricane hits or not this upcoming fall season has nothing to do with the tariffs that are being proposed right now, right? It has more to do with some butterfly wing, right, Way? Somewhere in Malaysia or what have you. And so access to reinsurance premiums through a structured bond format becomes very interesting from an investable standpoint. And I subscribe to this. We currently don't hold this. This is something we're doing due diligence on ourselves because it is something that's worth considering for our model portfolios. Whether we end up there or not, I don't know, but this is something we're giving serious consideration. Whether you should do it or not for your situation, I don't know. But this is something that, if you're thinking about it, I would encourage you to do due diligence on because there's an enhanced portfolio diversification piece to this and the stability from the standpoint of it really is uncorrelated with the market. And so you see the difference between this argument and holding gold or something like that for a portfolio weight.
In terms of the lack of correlation, that now maybe a concern people might have, this does depend on actuaries being right about the expected frequency and severity of the catastrophes.
Yeah, no,
And
you're
just
absolutely
people, as
right.
we watch the news recently, it seems like the rate
You
of catastrophes is increasing, which
you could
would
throw
that
in
make this a bad investment if we get more catastrophes than
absolutely. You
expected?
can you can throw in the quote unquote global warming, and I'm not saying it like sometimes there's no global warming or there is global warming. I'm just throwing it out there that you can make the case there could be increased natural disasters. Interestingly enough, the best time that you will find to invest in these is right after a natural disaster, simply because these companies really their premiums go up a lot, and so it's almost like the highest expected return is right after one of these. But yeah, you're absolutely right. There's one of these that's an issue of risk that you're taking on, and so it's not a free lunch in that sense. Where it gets interesting in individually itself. Would I own a catastrophe bond and nothing else? No. Would I own an allocation into catastrophe bonds within a portfolio? I would definitely give it its proper due diligence because I think it's worth reviewing from that managed vantage point. Now, is there an ability for somebody to invest in this? There are some liquid and semi-liquid options available. There's catastrophe bond ETFs that are out there. XILS is one of them. Again, not an endorsement, just if you're looking at due diligence, you can start there and go from there. And they offer daily liquidity. There's interval funds, which is, I would look at that more so than daily ones, offered through Stone Ridge, which provide quarterly redemption. This is interesting because they're just able, the investment mandates are different from a liquid daily liquidity to non-daily liquidity. And I think to get the full effects of this, you kind of need to let go of the daily liquidity requirement. But again, that's just an opinion, not a matter of fact. So you see these things being offered more and more to investors. You're seeing advisors get into this space more and more. And again, not because, it's trendy or anything like that, but because through technology, you're able to now offer certain investment vehicles with a level of liquidity that you didn't have before. And again, the role of any portfolio manager is not to try to guess where things are going consistently over and over again. Ultimately, that's a fool's errand. To me, the role is to expose yourself to asset classes that are bringing in certain returns expectations per unit of risk, going back to what the common theme of all of this. And this is something that would merit consideration based on how it's set up. Now, there are some catastrophe bonds out there that offer bond solutions as well, through interval funds. Again, gold, Stone Ridge, Fermat Capital is the largest dedicated catastrophe bond manager out there. There's a lot of them out there that you can start doing due diligence on. The role in the portfolio, as you can imagine, is the diversification benefit. Now, within that, you can buy the bond directly, or you can get what's called quota shares. Quota shares are really for higher net worth investors. And what you're doing here is that an insurance company is just looking at their balance sheet and they're trying to offload the risk directly, not through a bond, because a bond you could, effectively the dividends are at play and things along those lines. You're helping fund that company, but here you're actually taking on the risk hand in hand with the insurer. They're looking at their balance sheet and they're saying, "Hey, does anyone want to take this $100 million liability for me?" Right? And then the company can say, "Yeah, I'll take 10% of that." Another company says, "Yeah, I'll take 20% of that." And they're on the hook as if they are the reinsurer themselves. From that standpoint, they're really participating in the balance sheet directly of that insurance company with those catastrophe, linked to the catastrophe bonds. Now, again, that's to your point now, Wade. That's linked directly to the underwriting performance, not necessarily the market behavior. And so, if you're doing quota shares, yeah, there's an extra level of risk to your point. And here, they're trying to get it right. How many hurricanes should we expect? They probably have more meteorologists on their staff than economists at this point, because they have to kind of really stay ahead of the curve. You know how in many advisory firms you see CNBC on the waiting rooms. Here you have the Weather Channel
Weather Channel.
all day, all night kind of thing. Now, again, this diversifies the portfolio a little bit more because you're almost like a private equity investor in the balance sheet of this company. And again, the risk transfer is even more pronounced because your losses you can go to zero, in a heartbeat. Simply because if you get three back-to-back hurricanes in the heart of South Florida, that's hard to cover, right? And so you do get the alternative yields with real asset characteristics here. So it's a very interesting play, albeit this is more pronounced, if you will. Are there any options that investors have? There's no public at least that when I did my perusal, there's no public ETFs or mutual fund company options currently available because you're getting here at the participation level. So it'd be nearly impossible to be able to create that kind of infrastructure. What you do is the investment parlance for this is called sidecar investment vehicles, where Stone Ridge themselves will use this to buy, to get to participate in the balance sheet of that reinsurer, if you will. But again, the minimums are very high, and you're going to be locked up for multiple year periods if you want this kind of exposure. Now, is there anyone that offers anything like this to folks? Yeah, Swiss Re and Munich Re. Again, these are big levels. They offer investor backed sidecars, reinsurance sidecars. But again, you're talking at high levels. So this is just for direct institutional investors. Sometimes you have Stone Ridge and 12 Capital where they manage hybrid funds and they'll have some quota share exposures within that. And so you can look at it if you really want it bad enough from that standpoint, from a due diligence perspective. But again, catastrophe insurance is an interesting play, much like private credit that we've talked about in previous episodes, where private credit, catastrophe insurance are things that are, at least from my vantage point, from a portfolio construction standpoint, are very interesting. I think those are things that merit strong consideration within a portfolio. Whether it's your portfolio or not, that I can't answer because you'd have to look at everything else. But within a portfolio that's probably diversified, is there potentially a home for those? I, I potentially think the answer is yes, but like anything, it depends. And that's where we're landing on, Wade, with regards to the arc on private equity. Now, we didn't get into crypto and all of that because I think that just merits an arc in and of itself that at some point we'll get to, just not now.
Okay, so crypto, something to look forward to at some unspecified future date.
There you have it.
But from here, yeah, we'll be getting soon into our series from the Q&A sessions related to that YouTube live we had on June 2nd. So please stay tuned for that. And thanks for your attention during our series on alternative investments. And thank you, Alex, for all the research you've done to prepare for this as well.
No worries, Wade. All right, everyone. Thank you so much. And we look forward to catching you next week on
Retire with Style.
There it is. Bye, everyone.